Let me remind you that trading Forex is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. So please always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. This is an interactive session. You're free to ask questions. Let me go through the agenda. We're going to start with an overview of the Federal Reserve System. Then at 2 o'clock, which is 28 minutes from now, the decision will be made. Bum, ba, da, da. Okay. And that'll be interesting. The decision's already priced in, however. And we can discuss that if you want a little bit later. But the big news of the day is going to be at 2:30 in the afternoon. So 1 hour from now, we're going to have the Janet Yellen press conference, and that's going to be very interesting. And I'm really... what we're focused on is how many more interest rate hikes that we're going to have over the course of the next 12 months. And, you know, everyone's guess is every other meeting right now, and I don't see why that couldn't be the case. But it's an opportunity to learn new information at 2:30. We're going to find out what their actual policy is, okay? So that's going to be very, very important. A couple of people had questions about Forex.Today. Where are my daily sessions archived? The most recent ones are down here on the right-hand side of Forex.Today. And you can also click up here. And these are just my webinars that I do day after day after day after day, which is cool. We also have a team of analysts stationed around the world watching the markets, and they're posting their trading ideas. So, you know, feel free to go through all these posts as far as technical analysis and trading setups. I should probably introduce myself. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, and it's an ECN that gives Forex traders access to not just the interbanking system, but they do that with a direct connection, but also access to energies, metals, indices, and stuff. Anything that you want to trade, we have it available for you. Hey, these sessions start at 7:30 in the morning. Like I said, Monday through Thursday at 7:30 in the morning. I go through technical analysis, fundamental analysis. If it's a Monday, what I do is I set up the trading week, go through the calendar, look for event risks and opportunities. I also go through the commitment of traders report, which shows us the large institutional positions in the market. And I'm looking for changes of trend in there. That's 7:30 in the morning here at Forex.Today. But every Friday, I host a webinar at FXStreet.com. The last one I did had 650 people registered. I've been doing webinars at FX Street for over 10 years now. Almost 12 years, I think. So you're welcome to join. Is it paid sessions? No. Yeah, my pleasure, Mike. So, as I said, what I'd like to do is make sure we all are on the same page, the same common denominator amongst currency traders here. And I thought I'd cover what the who the Fed is, what is the FOMC, and what do they do. Okay, Currency Trader's Guide. So what is the purpose of the Fed? The Federal Reserve banking system in the United States has a mandate. What's the whole point? The whole point of the Fed is to keep the economy healthy and to keep inflation moderate. So you need to have some inflation, not too much. But if you're in a deflationary economy, that could be even worse than inflationary because you run out of tools. So like in the United States, when we ran into a deleveraging economy, we ran into this problem where you lower interest rates, which is the best way to stimulate an economy because it affects so many different parts of the economy. But what do you do when you lower interest rates to zero and nothing good has happened from this, drastic monetary policy? you get into a kind of a weird situation where there's not much traditional tools that you could use to stimulate the economy. And so we tried something that the Japanese tried 20 years ago. It hasn't worked that well, but the Japanese did invent something called quantitative easing, and that's to stimulate the economy, and they do that by buying bonds. But buying bonds is supposed to increase the money supply. However, it hasn't increased the money supply. What it's done is increase the monetary base, and that's why we're having a slow recovery. But the dual mandate is you need a healthy economy, and if inflation gets out of check, you need to adjust monetary policy to either create inflation or stop inflation. So what are the major tools? The Federal Reserve can change the R. Does anyone know what R is? R is just reserves. So when a bank receives a deposit from a client, 10% of that in the United States, 10% of that is required to be placed at the Fed. Okay? 10% has to go to the Fed automatically, and that's the R. That's required reserves. The required reserve ratio in the United States is 10%. How many times has China changed their reserve requirement ratio over the last 12 months? 4, 5, 6 times? When was the last time the United States changed their reserve requirement ratio? (1992). 1992. The reason is it's sort of it's a very, very blunt tool. So if you change the reserve requirement, it can have profound effects on the U.S. economy, but not in measured ways. And it's also a very, very, very expensive, difficult thing for the banking system to adjust to a change in the reserve requirement ratios, right? So it just never happens in a mature economy like the United States. Now, excess reserves are reserves parked at the Fed, because you have to realize the Fed, the Federal Reserve banking system, is really just a banking system for banks, right? So banks receive deposits from clients, 10% gets parked at the Fed. What does the bank do? Let's say Bank of America. What does it do with the other 90% of your deposit? It tries to make money. So how does a bank make money? They loan it out. Thank you very much. If they can do that, then the fractional reserve banking process will actually multiply those deposits. And that's actually where money is created. Okay? Because what happens is 10% gets parked at the Fed, 90% gets loaned out, which means it just goes to someone else's bank account. 10% of that goes to the Fed, 90% of that gets loaned out. You see? And that loan, let's say to buy a car, just simply goes into the car dealer's bank account, and 10% goes to the Fed, 90% of that gets loaned out through another loan, and it goes on and on and on and on and on. And what happens is everything is multiplied by 10. $100,000 deposit creates $1 million worth of new money in the money supply through the fractional reserve banking system, if the bank actually loans it out. Right now, they're actually not making those loans. So what could possibly the bank do if they don't want to make those loans? Well, they can buy bonds, right? Treasuries, really. They can't buy corporate bonds. And they can make money on that, or they could just park it at the Fed as excess reserves. It's not required to be parked at the Fed, but it's their bank account. So it's kind of like sitting on cash. The Fed right now is paying them a little bit of interest, so it's not so bad. They can do whatever. But you can do some things like adjust the discount window and stuff to try to force, right, those excess reserves from the monetary base, which means it's just parked at the Fed, into the money supply, which means it's going through that fractional reserve process. right? The fractional banking process. So what is the ECB trying right now as a test? What is the ECB, the European Central Bank, doing right now to try to force money out of excess reserves and into the money supply? They have a negative yield at the deposit rate. What that means is if a commercial bank has money parked at the ECB, which is a similar system as the Fed, they will actually charge the bank money. In the United States, they pay them money to park it at the Fed. The ECB is saying, no, 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 no. We're buying bonds, but if all you do is park it here at the ECB, we're going to charge you money, so you might as well put it into the system, okay? But what is the number one tool used to stimulate the economy and keep inflation in check? Open market operations. This is something the Fed does all day, every single day. The Fed in New York, the New York Fed actually has a dealing desk. And what they do is buy and sell bonds, because the Fed doesn't, if Janet Yellen raises interest rates today, which she probably will, it's not like a law has been passed like this is the interest rate. No, what actually happens is the Fed says this is our target rate. So we're going to buy bonds or sell bonds and move interest rates up and down. We'll force it through open market operations. But the cool thing about this is they can get it 0.25%. And if they want to raise it again to 0.5%, they can go in and they can just adjust their buying and selling of bonds to produce the interest rate through buying and selling in the open market, just like anybody else. And therefore, it's very fine-tuned versus changing the reserve requirement ratio is sort of, like the nuclear bomb of monetary policy. It just could create total devastation and destruction. You don't really know. Now, an OMO is more like a sniper. You get exactly what you want, one shot, one kill. So the Fed's going to prefer to do that all day, everywhere, all day, every day, right? So why is the money supply a vertical line? Well, academically, it's a vertical line. That's because it has nothing to do with interest rates. The Fed can buy bonds and put money into the money supply. They can, and it also comes down to how many loans banks make, and then how much of those loans are spent, and all that stuff creates money. But if the Fed wanted to increase money supply, they would simply buy bonds, right? Because if they buy a bond, what happens? The bond dealer gives the Fed the bond, the Fed gives the dealer money. The money eventually goes into the dealer's bank account, and then it goes through the fractional reserve banking system, and that's multiplied through the money multiplier, which is 1 over R plus E, 1 over required reserves plus excess reserves, otherwise known as total reserves, okay? So that's one way to increase the money supply. But what if they want to decrease the money supply? They would sell bonds, and right? So they give the bond back to the market and they pull the money out. And this will actually change interest rates, because the equilibrium point between money supply and demand for money is going to create that interest rate. Okay? So if the Fed wants to, in this case, the Fed's going to sell bonds, in this example, what happens? The Fed sells bonds. Bond, right? That means the supply of bonds goes up. What happens when supply goes up? What happens to price of anything? Price goes down, and therefore interest rates go up. So what the Fed, if the Fed decides to raise interest rates, in this case, increase interest rates by 0.25%, what they're actually doing is going into using open market operations, selling bonds, lowering the price of bonds, and increasing the interest rate in the market. Isn't that cool? That's actually what they do. Again, it's not a law. Okay? So the Fed goes in, buys a bunch of bonds, total deposits, 1 over R plus E times that deposit. It's multiplied and turns into 10 billion. Total deposits are, right? So they can spend a little bit of money, $1 billion worth of buying. If the Fed goes in and buys $1 billion, I'll skip some of these, right? If the Fed goes in and buys $1 billion and the fractional reserve process, the fractional banking process takes place, it actually, at the end of the day, becomes 10 times greater. So the Federal Reserve Bank of the United States. Let me give you a history of the Fed. Now, first of all, I need to make a point. There isn't a central bank of the United States. There's a central banking system, which is really cool. It's really cool. But how did this all start? This is actually the third attempt at creating a Fed, a central bank. But the Americans hated centralized power. That's the whole point, right? They left England because they didn't like the king. So they get to the United States and they start their colonies, and then they finally create a national government. But they were always worried about centralized power, because if you have a president that is too powerful, then he ends up just being a king. And then you kind of, you're right back to where you were before. Okay. So anyway, so they've never liked this centralized power. But what happened was you'd have these giant booms and busts, boom and bust, boom and bust, boom and bust. And there was no lender of last resort. What happens is you'd have a run on a bank, and the bank would fail because they've made long-term investments, but they have short-term liabilities to you. And so if you withdraw the money, they don't actually have the cash, because they've made these long-term investments like mortgages, and all of a sudden there's a liquidity crisis and there's a run on the bank, and it could actually spread, and all of a sudden there could be a run on all banks, because you'll hear about your buddy down the street lost his entire life savings because the bank folded. So now you run to your bank and try to get your cash, and it all failed, right? And so these runs would occur, and it was a terrible boom and bust cycle for the United States. So guess who bailed everybody out? It was always J.P. Morgan. J.P. Morgan used to bail out the entire U.S. economy because he was that wealthy. But the problem is, this is kind of scary for J.P. Morgan to have to go through this process. So he and his buddies get together, they leave New York City, and they go down to his hunting lodge in Jekyll Island, Georgia. Now, I've been to Jekyll Island. I've been in the actual hotel. I've actually been in the meeting room where they created the Fed, and I slept in the penthouse suite, which was really funny because I showed up to check in, and it turns out the Fed still holds secret meetings there. And they're like, "Sir, the penthouse isn't ready for you to go in." I'm like, "What are you talking about? I got the penthouse. You need, And he says, "Ben Bernanke's still in the room." True story. Let me tell you, Jekyll Island, Georgia is still in the middle of nowhere in 1907. Just absolute ridiculous middle of nowhere. But he gets together with all his powerful buddies, and they design the first central or the Federal Reserve Bank of the United States. But they got to sell this politically, right? By the way, that's when it got signed into law. So how did they get this passed politically? Because remember, Americans didn't like the central power. So instead of having one central bank, they decided to create a whole system of central banks all around the world. And how powerful were farmers back in 1907? There's two Federal Reserve Banks in Missouri, right in the heart of America, right? Pretty amazing stuff. So what they were trying to do is they wanted to make sure that people in California didn't feel like, New York City guys were going to run everything. And same thing, the farmers hated the politicians and the New Yorkers, right? So they created a system, and each local branch would represent that area. So the San Francisco Fed is basically the central bank for the Western United States. Very clever. And so they got all this together, and they were able to pass things politically. Oops. Yeah. So it's anyway. So it's a system, right? So each system has its own central bank. 50% of all the assets, however, are on New York, Chicago, and San Francisco. The same, it's moved away from Missouri, and the big money is still in these areas, right? So each central bank, each regional bank, right, has its own stockholders, which are the corporations and banks that are members. Each Fed elects its 6 directors, right? 3 directors are also appointed by the Board of Governors. And the 9 appoint a president, but then they still need to get approval from the Board of Governors. And the Board of Governors are in Washington, D.C. Okay? The 9 directors are 3 professional bankers, 3 business or community leaders, and then 3 are appointed by the Board of Governors, and these are usually economists and academic people, right? And this group of 9, at each bank, remember, all around the United States, each central bank has its own group of 9, and they provide a well-rounded overview of, as a team. Okay, so the leaders and staff for each regional bank, they gather economic statistics. So they're all the quants and the PhDs, they're looking at past performance and calculating, past inflation, past growth, past this, past that. However, the president goes to all the different business leaders in their region and sit down and talk with them and ask them, how do you feel about the future? What are new orders looking like? How are sales? What do your customers think? How do your customers feel about the future? And they're asking all these business leaders, and it's outward looking, right? Now they take this past data and this sort of outlook, economic outlook for, let's say, the Western region, right? Let's say the San Francisco Fed will take all of this, compile it together in a beige book, and it's actually called the beige book, and they actually make this information public. Now, this is important, though, because if San Francisco's in recession, Detroit could be in depression, couldn't it? So the federal version of, the national version, the Board of Governors will need this information if they're going to make informed decisions about the economy as a whole. So anyways, the Board of Governors located in Washington, D.C. There are 7 governors appointed by the President of the United States and confirmed by the Senate. So there's a big, nice political vetting process. And they serve 14-year terms, rotating. So like the President of the United States can't just show up and say, Janet Yellen, print money, monetize our debt. No. Grandma Yellen's the most powerful person in the universe. She controls the money, right? President Obama just controls nuclear bombs, and that's it. All he can do is attack a third world country. Janet Yellen controls money globally. Who's more powerful, right? Yeah, thanks for the heads up. I know there's so much going on here. Let me pull up some data in the background. Well, there we go. We're going to use tradethenews.com. Let me log in. I know I'm moving fast. I'm fired up. Hopefully it's not too fast. And all right, so where is the webinar? Where'd the webinar go? There you guys are. All right, everybody good? So we have time. Yep, we still got 5 minutes. All right, good. All right, so anyways, so the Fed is independent of politics, which is really, really important. And these governors now, the Board of Governors in Washington, D.C., they tend to be hardcore economists. Okay? Now, the 7, they elect a chair out of the group, right? And that person becomes the chair of the Board of Governors. Who's the chair of the Board of Governors right now? Chairperson Yellen, right? She used to be president of the San Francisco Fed. Yeah. Yeah, I used to, when I was a venture capitalist, we worked out of the top 3 floors, I think it was, of a skyscraper in downtown San Francisco. Beautiful views of San Francisco Bay and the Bay Bridge and Treasure Island, and we were right next to the Fed in San Francisco. It's pretty cool, and she was obviously a power player there. So, anyways, being a chairperson of the Board of Governors, super powerful. Meets with the President of the United States almost on demand. Delivers press conferences, testifies in front of Congress and the Senate, has the power to negotiate economic matters in foreign governments. Oh, and also gets to run the FOMC. Bum-ba-da-da. So that's where we are with 3 minutes to go. That's the meeting. There's Grandma yelling. Okay, yeah, Ben's gone, but anyways, there's the actual event. And what I'll do is I'll continue after the news comes out. We're going to have a lot of volatility in the market, and then I'll teach you more about what actually happens in the meeting. We'll go through the entire 2-day agenda, and I'll tell you who says what, how, and why. Does that sound good? So I'm just setting the stage here. We're just a couple of minutes away from the actual interest rate decision. The big news, remember, the big news is really at 2:30. That's why we can watch the volatility. The market's going to freak out. It should be priced in. So there's just going to be a lot of speculators. And then when it's all said and done, we'll get back. I'll finish the presentation. We'll prepare for the real event, which is the press conference.
This is a 24-hour live broadcast test channel from the Trade the News Broadcast Network. If you are hearing this message, your sound card and network configuration are working properly.
All right.
FOMC rate decision.
All right. Let me double check, you guys. Oh, you know what? Sorry. See, this is why I double check. All right. There's some charts. You got some charts. We're about 45 seconds away. Woohoo! This is good. Now, you've had an opportunity to lock your stops days ago, really. And as I've seen looking at the Commitment Traders report, a lot of money is coming out of the market. So you may be the only one. If you're putting trades down now, you're probably the only one. By the way, Puerto Rico is going to default.
Rate decision due out in just a few seconds.
Puerto Rico. Oh, here we go.
Raises 25 basis points as expected, raises 25 basis points.
Emphasizing the actual path will depend on the economic outlook, and they're informed by the data.
Fed saying reinvestment to continue until rate normalization is well underway. Vote was 10-0, so no dissenters. No dissenters.
Fed officials say they see the median rate at 1.375% at the end of 2016, so no change in their dot plot for 2016.
And a lack of dissenters and maintaining the dot plot may be taken as hawkish.
And we're seeing the euro come under pressure and interest rates move higher following the initial statement.
Updated economic forecast, 2016 GDP now seen 2.4%, up from 2.3% prior unemployment.
It is worth noting they are taking down their median dot plot for 2017, the median rate falling to 2.375% from 2.625%, also moving lower for 2018, now falling about to 3.25% from 3.75%. The long run rate holding at 3.5%, say FOMC officials.
Okay, not a lot of surprises yet. And like I said, the big news of the day is going to be the press conference. One thing to point out here is a monthly R1 weekly M2 pivot cluster is held. Okay. Nice little bounce. So things are working technically. Great opportunity to lose money too. So anyways, all of this should have been priced in. Smart money's actually got out last week. So the big question is, will we resume? Okay. So let me zoom back in. So I'm just trying to put this in different context. Okay. Remember, if you're a bear, you want to sell high. You want to sell high at resistance. Don't worry about things like oscillators and stuff. They're going to be too slow in a high volatility event-driven strategy like this. Mike got taken out by the spread. This is a risk that you're taking on. It's not likely your broker. Like, for example, what TradersWay does is simply enter your trade into the interbanking system. The interbanking system doesn't want you trading at a time like this, and the interbanking system spread goes up. So when you trade an event-driven strategy like this, especially a big fundamental game changer, you're going to assume additional risk than the normal risk that you trade in Forex. And that is things like slippage and spread widening. It's your choice. Okay. Like I was saying, what was it, on Monday or Tuesday? If you want to be in this going into the Fed meeting, you should be up in here at the reversal pivots, right? This is the monthly reversal pivot. We touched it, Monday afternoon, Tuesday morning. All right. So that's where you should be going into the event. You should be short here. The short just before or just after the event is, financial suicide. Yeah, Mike says it was TradersWay. It's the interbanking system. That's what happens with an ECN. They're not marking up spreads. It's the interbanking system, the actual big system that JP Morgan and Deutsche Bank are playing in. It's those spreads that widen. So again, smart money would be trading this well before or well after the event. Okay. So going into the 1 minute, this is the big candle. It drifted back down. So it dropped, came back 618, and then dropped again. But this is as clear as mud. So I wouldn't get too excited about throwing down big amounts of money right now, because again, all of this was priced in. We need new information to find out what will happen moving forward. So we got the hike that we expected. The dot plots haven't changed. There was no dissenters. Just everything is kind of like as expected, textbook scenario. Now the conference, though, Janet Yellen is going to tell us more about their decision, more about the future, and there's always a chance that she messes up and says something. Like a reporter presses really hard and she says, we're thinking 3%, or we're going to keep raising until 3%. Wow, that would be ridiculous and completely unexpected and not priced in. Therefore, an opportunity to make money. But remember, a professional trader wants the opportunity to make money without taking high amounts of risk. In the moment, like right now, right this second, there's too much risk associated with this. Okay? So what we want to know more about is the fundamental macro trend and how long and how far the central banking divergence in policy will continue. All right. The ECB has negative deposit rates, trying to increase the money supply. Right? And they're doing quantitative easing. The United States is raising interest rates, doing the exact opposite. So, like we predicted, 2 years ago, so like this whole area up here, quite a few of you guys were with me during this period. It's about a 6-month period. It's when quantitative easing was being legally created in or allowed by the ECB, but also that's where the Fed was starting their taper. And that 6-month period, I prepared you guys for 6 months for this drop. Right? How many people can confirm that you had a 6-month heads up window to prepare for the ultimate perfect storm of central banking divergence? Right? Yeah. So now we're at this double bottom, and these are pivot points. It just shows you how far we're zoomed out. You know, do we have to trade right this second? No, the actual trade here was yesterday, and nothing's actually changed technically. Let me get a drawing tool. Okay. So we got a lot of lines here, right? Wayne, yeah, so I covered that. Actually, if you go to Forex.Today, look at Monday's video on the commitment to traders report, I cover that. Okay. But, okay, this is what should happen based on the textbooks. Okay. The nice thing is this is happening exactly where you'd want it to happen. The oscillator is just perfect. So do I feel like I need to risk a bunch of client money and throw down a trade now? No. Right? No, you're supposed to be short up here. Does anybody know what monthly M4 is? What kind of pivot point is monthly M4? It's a reversal pivot point. It's actually a reversal pivot point. And look, the market reversed. How cool is that? So what I'm hoping maybe on a smaller time frame is, you know, this could drop today. It could even pull back today. But over the course of the next few weeks or months, this might happen. Okay, based on fundamental analysis of macroeconomics. So I'm just saying you don't have to feel compelled to have to be short right this second. Now, if you are going to trade, I would, you know, I would consider it. How about this? It would be better to trade now than 1 or 2 minutes after the event, because the spreads are likely have gone back to normal, right? Yeah, spreads are normal, fine. Okay, so again, we haven't learned anything new. I don't think what's happened is going to bring new money into the market. And if you're a bear on this, do you want to sell at support or do you want to sell at resistance? Sell at resistance. Are we at resistance now? No. Then, you know, then stop sweating bullets, right? So what's your plan? Create a plan. If you're going to do it, have a plan, right? So now we've let the spreads normalize. The likelihood of slippage is diminished. You just have a lot of volatility and uncertainty. Okay. But if you're gonna do something, at least find some pullbacks of resistance in which you can get a little bit better of a price. And don't ignore things like the psych levels and stuff, right? So what's the actual price in the moment? Yeah, we're right on 109, right? And pivot cluster. So just chill out, right? You don't have to be in the trade in the next 2 minutes, do you? Charlie did the binary. Good job. That's one way of playing a high volatility, event-driven strategy without the volatility risk. Now, cool. Hey, did anyone catch the segment I did on the junk bond market on Monday? Cool, huh? So the big question, guys, is if money's coming out of junk bonds, is some of it going to go to other markets like the equity markets? Or are they just going to roll it over into just a regular bond? Why would you be high yield and then want a low yielding risk-free bond, right? So hopefully we can track that money. All right, so we're going to wait for new information. You can stay trading this if you want. I'm going to continue with the slideshow, and I'll tell you what has happened over the last 2 months, or sorry, 2 months, 2 days at the FOMC, And then the big news of the day is going to be at 2:30, and hopefully we learn something there. And I think the better trade's going to be then. Oh, by the way, just a little heads up on the 1 minute. We're getting closer to this resistance. Okay, this could be a nice little whoop whoop. Okay, at least now you're at resistance. Okay, be careful. Be careful. Look at this whip sign. These are stops getting knocked out. We're right back to where we were before. Back to where we were before. Okay, be smart about it. All right, so let's go back. Let's finish this. All right, the Federal Reserve Open Market Committee. Okay, they meet 8 times a year. So one of the things we want to try to learn about in at 2:30 during Janet Yellen's press conference, we want to know how many times this year that they're going to raise interest rates, because we're presuming this is a trend in interest rates. They're just not going to hike it to this, quarter point and then that's it, right? So they're going to meet 8 times a year. My guess is that every other meeting they're going to raise interest rates. And if so, at the end of 1 year, we'll be at a full percent, right? So they set the monetary policy for open market operations. So they're the ones that decide, go into the market and buy or sell bonds and manipulate interest rates to what we want. Okay? So the FOMC, the Federal Open Market Committee, consists of the 7 Board of Governors, the president of the New York Fed, and then 4 of the other 12 presidents. Now, all presidents get to go there, but only 4 of them get to vote. Okay? Now, why does the president of the New York Fed always get to vote? No, by the way, the reserve requirement ratio is not set by the Federal Open Market Committee. It's set by the Board of Governors. Okay, so don't go into the RRR. All right, so, okay. Why? Right, the president of the New York Fed is the one that actually oversees the trading desk. So when the committee gets together and says, raise interest rates by a quarter point, well, the president of the New York Fed actually has to do it. Their desk actually has to go into the market and actually manipulate the interest rate. Because it's not law, they have to buy and sell bonds to get interest rates at the Fed funds interest rate level, right, at exactly that quarter percent that they want, right? It's pretty amazing stuff. So that's why, okay? The reserve requirement ratio and the discount rate are not set by the Fed. By the way, if I don't go into it in this presentation, I can cover all the different interest rates from the Fed funds rate to the discount rate to the prime rate. We can go through all these different rates if you're not sure what they are. And of course, feel free to ask questions as well, okay? You're the boss. I'm your humble servant. Okay? So here's the meeting. Everyone flies to Washington, D.C., and they go to the Board of Governors office. Non-voting presidents fully deliberate, which means they get to ask questions, they get to participate in all the conversations, they just don't get to vote. But remember, each president represents a different region of the United States, so their knowledge and their opinion really does matter to the committee, but they take turns voting, right? So anyways, the staff of the Board of Governors and the district banks also attend, but they never speak. So all around the room, you see these guys sitting around the edges? They're the staffers. All right? They're the staffers. They never say anything. All right? If they say anything, they're shot. They just throw them out the window. All right? So they they just sit there and that's it. They're dummies, right? No, they're doing their job. All right. Okay. The Board of Governors Director of Research opens up the meeting. and gives an overview to the FOMC about their research, right? So that goes on for a while. Then the Board of Governors Director of Monetary Affairs present. And this is where they talk about buying and selling bonds in the open market. That's where they discuss the OMOs and stuff like that, right? And then the Secretary of the FOMC takes all the minutes. Very nice. So day one, this was yesterday, day one. They come in, first thing they do, approve the previous meeting minutes. Then the report of OMOs are done, right? Foreign currency and domestic operations. So the guy in charge of the actual trading desk comes in. Think about it. First thing they do is approve the minutes. The second thing, let's talk about trading, right? How's it going? So think about what is the most important part of this whole process, right? Open market operations. So the manager comes in, he reports what's going on the trading desk at the New York Fed. They vote to ratify all these OMOs, and then they move on.com. Board of Governors staff now do presentations on the National Economic Forecast. This is called the Green Book. It's not a public document, okay? But they just start off, the PhDs come out, and they talk about what's happening in the United States. But it's a forecast. What could happen in the future? And they give a couple of different scenarios, like if this happens, that might happen. If this other thing happens, this other thing, right? If then, if then, if then. Then each president gives their regional economic overview, okay, supported by the stats that are in the beige book, which is public. So the president of the San Francisco Fed says, hey, we're in recession. All right. And the guys from Detroit, they say, hey, we're in deep depression. Okay. So they give their regional view. Each governor gives their national view. But monetary policy is not discussed in day one. It's just sort of the state of the economy from different points of view, over and over and over and over again. Okay. Which is important. Then I'm sure there's a dinner and all that kind of stuff, and they play games. And then day two, the Director of Monetary Affairs presents a scenario for various monetary policy actions. So they say, look, if we don't raise interest rates today, here's what I think is going to happen. Blah, 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 blah. If we raise by a quarter point, here's what I think will happen. Blah, 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 blah. If we raise by 50 basis points, here's what I think will happen. Blah, 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 blah. And they just sort of like set the table, okay? Because all these presidents are there thinking, okay, what am I going to do? How am I going to vote? And he lays it out. This is, if you vote this way, here's what probably will happen, okay? So now the voting and non-voting members get together and they discuss and they debate the monetary policy. All right, well, if the economy is slowing down, what should we do to stimulate it? And by how much and at what rate and all this kind of stuff. So, I study economics at Harvard, and so we don't talk about money supply. We talk about monetary base and how to get it in the money supply. And then we talk about, it's not just the supply of money, but it's the velocity of money. And you're like, oh my gosh. And what is the slope of the demand curve for loanable funds? And it just goes, your head explodes, right? Your head explodes. So anyways, they start discussing, well, what should we do? What should we do? What should we do? Okay, they also discuss what the statement should be. Then Grandma Yellen is going to get together and say, all right, everybody, this is what we said, and this is how we feel, and here's what I think we should say in the statement. All right, so they finally bang out a statement. The secretary reads the proposed wording, and then members of the FOMC will actually vote, and this just happened. Okay, and usually this statement used to happen at 2:15. Now it happens at 2. I don't know why they changed it. Okay, now maybe because of the press conference. So the press conference now, I think we're going to learn a lot more. So again, their traditional functions, conducting monetary policy. They also supervise and regulate financial institutions, which is important. And then let's see what this last one is, because there's things I'd like to say. Conducting monetary policy, all this crap. All right. So let's talk about a couple of things. I just want to get into the meat of this. I don't have a slide, so I'm just going to talk out loud if you don't mind, and we can watch the charts as it's happening. Look, nothing's happened. We're right back to where we were. By the way, is this a trend now? No, so kill your trend tools. All right, so a couple of things. The Fed funds rate, okay, that's what was adjusted today. What is the Fed funds rate? Anybody get confused on such a thing? What is the Fed funds rate? The Fed funds rate is the market for which banks can borrow money in case they don't have the cash to meet their reserve requirement ratios. Now, remember, the reserve requirement in the United States, oops, let me get this to the desktop. As you know, the reserve requirement ratio in the United States is 10%, okay? But the banks want to lend that money out in a traditional normal market. They want to loan it out. They want to either buy some bonds or even better, make some loans, because those loans could be at pretty high interest rates, right? But what if they don't have the cash? It's liquidity. Like a big customer came in and withdrew a bunch of cash. You're in your long-term investments, but you're right. But they're not really liquid. They're more illiquid, right? I mean, you're a 30-year a 30-year mortgage is a 30-year mortgage, but someone could come into the bank at any time and say, "Give me my money," because it's an on-demand deposit, right? Or if you're in a CD, a time deposit. That means every 6 months you could possibly need to pay these guys their cash. So you're short on cash and you're long on mortgages, for example. So you can get in this liquidity problem where you're worth it. You have good performing loans in your portfolio. You're just short on cash, right? So, if there's a big deposit, you might have to make a change in what you have sitting at the Fed. But you don't have the cash, so what can you do? You just go to the Fed funds market and you simply borrow Fed funds at the Fed funds rate. And it's a market of banks lending money to other banks so that those banks can meet their reserve requirements at the Fed. That's all it is. But it's where interest rates are born, really, because it'll affect everything down the line. Now, there's also something called the discount window. So let's say you're a bank manager now, you're short on cash, but you need to make some deposits at the Fed because you're going to be short at 5 p.m. and you don't want to miss your reserve requirement ratio. JP Morgan won't lend you the money. Bank of America won't lend you the money. Uh-oh. So you pick up the phone and you call the Fed and you're like, "Hey, Fed, I'm a little short on cash, but I have a great portfolio of long-term investments that are paying and performing. Will you lend me the money?" They'll do it, but at a higher rate than the Fed funds rate because they don't want to do it. Okay? Also, you get a free bonus. You know how when you go to a bank and you want to open up a checking account and you get a free toaster? Guess what happens? You go to the Fed, you're like, "Hey, Fed, for some reason, I couldn't raise the money in the Fed funds market. Will you loan me the money?" They're like, "Oh, we'll be happy to lend you the money. We're going to charge you a little bit more, and you get a free audit." Free audit. Yeah, because they want to know, is there blood in the water? What does JP Morgan and Bank of America know about your balance sheet and your cash flows and what do they know? There's probably something wrong. Because you should be able to go to the Fed funds market without any problem. Seriously, guys, if you needed $100 million tonight, easy money, you can just go straight to the Fed funds market. If you're a bank, pick it up, it wouldn't be a problem. So it'd be a really big red flag. The reason I bring this up is we were talking earlier about how the Fed does some regulatory stuff, and that's how they can kick in, right? Where was it? Supervising and regulating financial institutions, right? This is where they do stress tests and stuff. Now, the Fed also does things like they process checks and they have wiring service and all that kind of stuff, right? But if you write a paper check, it goes through the Fed. Okay, they do all that kind of stuff, but really, the monetary policy is what we all care about. But that's where that discount window comes in. they call it the discount window. It's a discount from the prime, right? No, what's the prime? The prime rate is what a bank will now charge its best customers. It's the best interest rate you're going to get on a loan. Okay? So right? So the first interest rate is the Fed funds rate. The second one is the discount rate, and the third one is the prime rate. And then as your best customers are obviously the lowest risk, right? And then as the risk profile increases, the interest rates are going to rise as well, because risk needs to be compensated. Okay. Oh, yes, Felipe is responding to Darrow. Yeah. So we're going to, again, we're only about 3 minutes now away from the press conference. Okay. And so maybe we learned something new here. All of this was priced in, and that's why I was trying to talk you out of trading, because I think I said it was a great opportunity to lose money, right? So now we got new information possibly hitting the market. How many rate hikes this year, and how quickly are you going to get to 1 or 2%? Is it going to be in 6 months, or is it going to be in 2 years? All of this will be new information and could possibly be a huge catalyst to this market. If she says 1 and done, Euro USD skyrockets. If she says we're going to jack up these rates as fast as possible, meeting after meeting after meeting, so in 1 year we'll be at 2%, holy smokes, Euro tanks. Okay. So remember, I believe the best way to make a lot of money trading Forex is not these small little trades that are late and after the fact. It's building portfolios based on global macroeconomics, one trade at a time, moving stops so that you're lowering your risk. Then add another trade, manage the stop until you've lowered the risk to 0, right? Add another trade, add another trade, add another trade. Okay? Over the course of time, if you're trading long-term trends based on global macroeconomics as well as technical analysis, you can put yourself into a lot of trades that are performing and paying you interest, because we're mark to market. The oldest Forex fund in the world was something called FX Concepts, run by a guy named John Taylor. And he made all his money for like 30 years in Forex. He paid himself $250 million a year for 30 years. And they made all their money just collecting interest payments and hedging out the exchange risk. Okay. So anyways, this is where we are in here. Still would like this to roll over to the downside. Just doesn't have to be now. Okay. I don't hear any discussion yet. I guess I'm still a couple of seconds early. Press conference should be starting very shortly.
She'll start with a statement that summarizes her version of the FOMC policy statement, and then go to Q&A.
Yeah, I didn't want to broadcast it only because I was worried about, since we have like 230 people in the room, I was worried about bandwidth issues and stuff, but thank you for posting that.
The long end of the U.S. Treasury curve continues to catch a bid now. The 10-year yield below 2.25%, the 30-year up half a point. Yield falling back to 2.9.
Uh-oh, blue. She's wearing a blue outfit. You know what that means, right? Sell, 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 sell.
There is still some room for improvement in the labor market.
Yeah, no, there was a time when you could almost I think we would look for Jean-Claude Trichet to wear a pink tie, and that meant rate hike.
Relative to our objectives of maximum employment and 2% inflation. Since March, the committee has stated that it would raise the target range for the federal funds rate when it had seen further improvement in the labor market.
Grandma looks good.
Its 2% objective over the medium term. In our judgment, these two criteria have now been satisfied. The labor market has clearly shown significant further improvement.
Her husband is an economist. Her son is an economist.
Added to the economy. And over the most recent 3 months, job gains have averaged an estimated 218,000 per month.
All right, big sell-off here. See, underwhelmed so far, huh? Pick your lines, guys. So let's do this while she's babbling on. Pick your lines. Where do you want to sell this if you're a bear? Don't get distracted if this is going up. Remember, do your job. Pay attention, the psych level's like 110. Okay. I should remind you that if you were trading with me last week, the sell was at 110.50. So again, messing around with this is pretty late and reactionary.
Supported household spending, and purchases of new motor vehicles have been particularly strong. Residential investment has been rising at a faster pace than last year, although the level of new home building still remains low. And outside of the drilling and mining sector, where lower oil prices have led to substantial cuts in investment outlays, business investment has posted solid gains. The committee.
Good sell on oil, man. Look at that. That was beautiful. We were in here earlier today, and I was neutral to bearish. I said, if you're going to get lucky, trade in the direction of the prevailing trend, and you'll be lucky more often.
The committee sees the risk to the outlook for both economic activity and the labor market as balanced. The anticipation of ongoing economic growth and additional improvement in labor market conditions is an important factor underpinning the committee's confidence that inflation.
Anybody watching gold?
By holding down import prices. As these transitory influences fade, and as the labor market strengthens further, the committee expects inflation to rise to 2% over the medium term.
Stock market has no problem with this.
In the inflation outlook rests importantly on its judgment that longer-run inflation expectations remain well anchored. In this regard, although some survey measures of longer-run inflation expectations have edged down, overall they've been reasonably stable. Market-based measures of inflation compensation remain near historically low levels. Although the declines in these measures
Pound yen stable, euro yen stable. All the yens are actually quite stable.
economic projections submitted for this meeting by FOMC participants. As always, each participant's projections are conditioned on his or her own view of appropriate.
Remember, as soon as she stops reading, she can say a lot of different things that can move this market. Yeah, I'm watching USD CAD as well. I kicked it off the 4-hour 21 yesterday.
Participants generally see the unemployment rate declining a little further next year.
So what's GDP? Consumer spending, business spending, government spending, net exports. Right? GDP goes up, spending goes up because it's productivity or how do you say it? Well, it leads to consumption. Consumption leads to inflation, right? You guys want to see the flow? I can do that for you. We can go into the intermarket. Very, very low volumes, guys. Be very careful. All right, so she's babbling on. Who wants to access to the video where I talk about the junk bond market? And then we go into the commitment of traders report, which I think's on here too. Yeah, here it is. And the interesting thing is, I don't see the volumes coming in, and this lost a lot of volume. Oh.
The low levels that are expected to prevail in the longer run. This expectation is consistent with the view that the neutral nominal federal funds rate, defined as the value of the federal funds rate that would be neither expansionary nor contractionary.
All right, that's interesting. They're neutral. They're going to keep interest rates below GDP.
And the Federal Reserve's very large holdings of longer-term securities. Had the neutral rate been running closer to its longer-run level, these policy actions would have been expected to foster a much more rapid economic expansion. The marked decline in the neutral federal funds rate may be partially attributable to a range of persistent economic headwinds that have weighed on aggregate.
Yeah, it is a bit dovish, isn't it? Noel, do you want to attend tomorrow's webinar? Is that what you mean, or do you mean the recording? Okay, the live webinar, just go to Forex.Today, click webinars. Thursday's webinar is right here. Okay, anyone else want to attend tomorrow's webinar? Please just click there. Yep, I do these webinars every single day for free. Yeah. All right, so the market is very disappointed. That was quite dovish. She said she's going to keep it below, what did she say? Basically, she's going to keep it below GDP. That's how I kind of read it. She says they're going to stay behind the curve, essentially. So imagine 2.5% GDP, 1% interest rate. Yeah, so they're neutral, guys, and this is a disappointment. Now, we're in a sell zone. We're in a sell zone. If you have a plan and you want to be a bear, you finally got a proper place. Okay, guys? I'm still listening, Felipe. She's talking in my ear.
Is well underway. Maintaining our sizable holdings of longer-term securities should help maintain accommodative financial conditions and should reduce the risk that the federal funds rate might return to the effective lower bound in the event of future adverse shocks. Finally, in conjunction with our policy statement, we also released an implementation note that provides details on
Yeah, everything's up. It's just dollar weakness, Mark. Don't get confused with the pound and the Aussie. It's just dollar weakness. Dollar index down.
rate of 1/4%. Both of these changes will be effective tomorrow. To ensure sufficient monetary control at the onset
Wait, she just said something.
process, we have, for the time being, suspended the aggregate cap on overnight reverse repurchase transactions that's been in place during the testing phase of this facility. Recall that the committee intends to phase out this facility when it is no longer needed to help control the federal funds rate.
All right, so they got something going on. I'm trying to figure it out.
A 1/4 percentage point increase in the discount rate for primary credit to 1%.
Increasing the discount.
Extensive testing of our policy tools in recent years.
This is your sell zone, guys. If you're a bear, wake up and smell the coffee.
Proceed smoothly. Nonetheless, as part of prudent contingency planning, we will be monitoring financial market developments closely in the coming days and are prepared to make adjustments to our tools if that proves necessary to maintain appropriate control over money market rates. Thank you. I will be happy to take your questions.
All right, Q&A time. They made a bunch of changes there, discount window and a facility, and there's a bunch of things. I need to do some reading.
And we have asked you for so long, why were you delaying? Why were you delaying? So I'll ask, given developments around the world, that there's still weakness and the inflation is still nowhere near your target. What made you say do it now? Some have said it was because you feared a lack of credibility if you didn't move. Did that play a role in your decision?
We decided to move at this time because we feel the conditions that we set out for a move.
Okay, so hang on. I got to find out where she's babbling on. I gotta mute her or something. I don't know what I did with her. I have 18 screens and I often can lose windows. So Janet Yellen's babbling on somewhere and I don't know where she is. Oh, I found it. Yeah, this is danger zone, guys, because she can say anything. All right, I'm just going to mute her. All right, so let's talk about this. Let's talk about technical analysis. Let's say you were still a bear and you were still thinking about selling this. Now you got to be careful because she can say anything and could change things. But let me get rid of the flow there. Let's take this to a 15-minute chart. Let's say in the realm of things you were interested in selling this. All right. This was yesterday's sell zone. Okay. It dipped below, made a new lower low, retracement, and your plan is to kick it off the 110 area, which is a 618 Fibonacci retracement. It can go higher, but that's not part of your plan. What you would like to do is eventually bring this back around and sell it, right? So the first thing you're going to need to do is identify your resistance. So let me move in a little closer. I have two levels of resistance. One based off of previous support here, which is our 618 over there, but also up here, that was actually last week's sell zone. Okay, and that would be the big top. If it goes above that, forget it. I mean, it's okay. That ain't going to happen today, most likely anyways. So the first area, your AO, your first area of opportunity, is for this to roll over this way, okay? You're up at resistance, and so the market didn't quite like what she said. It came out a little dovish, but she could say something right here, right now, that could change that perception in a heartbeat. And we continue mission in the direction of interest rates going up in the United States, quantitative easing in Europe, and this thing comes down like a ton of bricks. Okay? That might happen today. It could happen tomorrow. It could happen next week. Okay. Your job now is to take logical, intelligent trades and minimize risk. So if you're going to be a bear, then you need resistance. Are we at resistance? Yes. That's all I care about at the moment. Psychological level of 110, 618 Fibonacci retracement, selling a lower high after a lower low. Then you come into the smaller time frame like a 1 minute or a 5 minute. And now what we're looking for is a reversal pattern at resistance in the direction of the prevailing trend. Okay, higher high, higher low. Is that a reversal trend? No. Higher high, higher low. Is that a reversal pattern? No. How about, let's just say, how about double top, lower low? Yes. Okay. And so that what we'd be looking for when I clear this out is we need to get lower than we need to get lower than here. And I'd like to do it with a double top or lower high scenario. Okay. So what I'd like to see is maybe up to here, down to here, and then what? Well, if this happens, it's just game on for me. Right now, I don't want to be in this market at all. Okay? Even though this is only a 1 minute chart, if we kind of retest and then fail to make a higher high, that's the first part. Failure to make a higher high is the beginning of a reversal pattern and a downward move, because I know longer term it wants to fall. I know the macroeconomics say it wants to fall. I know we're in a zone in which it could possibly fall. So the beginning of the reversal is having it stop rising. Then confirmed now by a breach lower than that low. So in 20 minutes, if I'm down here, I have a green light now. I have the license to kill. I'm going to sell retracements. Okay? Right in here. And my stop's going to be here. I have low risk and high reward, because if I can get this right, I'm going to pick up hundreds of pips. Okay? These Euro USD moves are worth hundreds of pips. Hundreds. Okay? Now, JJ says this could go up. Yes, it totally could. This is a strange singularity in the time price continuum. Janet Yellen could say anything, and your technical analysis is completely worthless. But we haven't seen a change in policy that is unexpected. So really, for this to reverse is unlikely on the longer run. We've had this move, this big move here where we went from 105, okay, to 110. We had the big 500 pip move, but that wasn't people buying. That was people getting out of the short. That was obvious for years, right? Year and a half, right? So this was obvious, easy street kind of stuff, right? And then if you remember this, it was a beautiful gift, just boom. Okay, so just put everything into context. We're just sort of down here. Right? I guess you can't see that. We're just kind of down here. It's not the end of the world. Okay? The question is, are we going to come all the way back and touch here? What's the likelihood this is going to go up to 122? Frederick, I've gone from bearish to bullish on the Aussie dollar. I don't want to sell it. Okay, if you're going to sell a commodity currency to buy up a yen, consider CAD yen. If you want to talk more about it, log into the webinar tomorrow and we can go through it. Okay, Frederick? I'm happy to discuss it. Yeah. How many people are going to be here at the webinar tomorrow at Forex.Today? I do this every day. Now, this is a special event because we're in the afternoon, but I spend about an hour and a half a day with the Forex.Today community. So I'm happy, swing on by. I've been doing this a very long time, and I'm willing to share my experience and my thoughts. What time? I keep it pretty flexible. Okay, Sven. So it's usually an hour and 15 minutes, hour and a half, hour and 15 minutes ish. 7:30 to 8:45 is pretty typical. And then I record it and put it up on YouTube and on Forex.Today, so you can always catch it if you miss. Okay. Oh, Kiwi. You guys want to talk about Kiwi? By the way, thank you for asking questions. I always appreciate that. I didn't get the auction results on Tuesday. I just got sidetracked. Did anyone get the auction results? Was it a positive or a negative? Plus 1.8. Nice. I guess we're such at the yeah, okay. Now, for those that are new to trading, I'll get rid of Grandma yelling here. If you're scalping the New Zealand dollar, you should pay attention to dairy prices. Yeah, lactose is a traded commodity. I didn't know that before, right? Powdered milk, lactose, all these different things, right? So you can go to Forex.Today. Oops. And I actually did a video on how to correlate global dairy prices with the New Zealand dollar. So let me type this in, cows. Boom. Cows and kiwis, the hidden relationship with the New Zealand dollar and dairy prices. Lots of stuff on the site for you guys. All right, so we've had a pretty negative trend going on in global dairy prices for quite some time. New Zealand has cut interest rates. Okay. But wouldn't it be nice if that was the end? I don't know if it is, but they're one of their large trading partners is Australia. I read the meeting minutes from out of Australia. I pay attention to jobs and GDP. All of that is improving. The big worrisome part of Australia right now is the fact that they're supposed to be a net exporter, but currently they're a net importer. And that's just terrible, terrible, terrible news for the Australian dollar. But we've come down on the Aussie dollar versus USD, tested the 0.7000 mark, and it's held firm for weeks now. And it seems to me we've printed a bottom. And that would be good for New Zealand since they do a lot of business with Australia, obviously. And they're a lot less tied to China than a lot of other economies. So if Australia starts improving domestically, that can't be a bad thing for New Zealand. Okay. One of the things I've been recommending to people is if you can't catch the Kiwi yen, trade the Kiwi Swiss franc. All right. The Kiwi Swiss franc. Let me give you an example. What's the margin on a Kiwi Swiss franc? Like, what does it cost? What kind of margin is required for a $100,000 position? What? $1,200? $1,500? Boy, that's a little slow. I think I better be careful with all the things I'm running here. Right? What do you think? $1,500 margin sounds about right? Yeah, well, whatever leverage, normal leverage, not 1,000 to 1. All right. So I was in a Kiwi Swiss franc trade. New Zealand pays me money, but guess what? So does Switzerland. Switzerland is actually paying you money to borrow their cash. How strange is that? So I was earning $8 a day on a $100,000 position just on interest, but I get paid every day. $8 a day times 365 days a year, because I get paid 7 days a week. I'm making almost 200% interest on my money, guys, just on interest rate payments. Profiting big time. What? Now, if I was able to hold for a year, I'm going to make some pips too, right? So it's one of these things where you can certainly make 1,000% a year on a position based on how much real money you have in the market, not right? Because you're earning interest on your leveraged money, not on the margin. Isn't that cool, guys? Is anyone earning 200% in their bank accounts? Well, obviously we need to be compensated for risk, right? So what happens is, this is Aussie. It could work on Aussie, but so Kiwi was one that I was buying, and I got knocked out on one of these things because what I'm doing is I'm entering the trade. I'm collecting interest from New Zealand, but I'm also collecting interest from Switzerland. Okay, and what I'm trying to do is, let's say you enter a logical trade, like, you know, you catch a bounce at this pivot point, right? And let's say 4 hours later, it's profitable, right? So you jam your stop and you have no risk. And unfortunately, this is what it did to me. It came down just, I mean, I missed it just by a little bit, right? I was in it for a couple of days and still made a couple of days worth of interest in a small profit. But what I was hoping is I could stay in this forever. So what you could do, guys, is you get your first trade. So you're in this one. And over the course of time, you move your stop and you leave it. Comes down and you get another opportunity. You enter your trade and over time move your stop and now you leave it. And you start building positions. So if I had 2 open positions now, I'm risking $3,000 of actual cash out of my account, but I'm in $200,000 worth of New Zealand Swiss franc, right? Because I'm using the margin to borrow Swiss franc. Switzerland pays me to take the money out of the economy, so it weakens the Swiss franc, and therefore then I take that money and I put that in New Zealand, and I'm earning a carry on that. So I have $200,000 worth of Swiss franc converted into New Zealand dollars, and I'm earning 2.5 plus that. So let's say I'm earning 2 point, just for fun, let's say it's 2.5%, but not on my 3,000, on my 200,000. Okay. So at the end of 1 year, just in interest rates, just on my yield, I'll be paid $6,000. Holy snap. But what if I'm in this trade for the entire year? I could be up a couple of thousand pips. Not a problem. Not a problem. Right? So how does that add up? Say, let's just say it's $10 a pip. I have 2 positions, $20 per pip times 1,000 pips, $20,000, but I only have 3,000 invested. But remember, I collect $6,000 in interest. Okay? Now I've earned $26,000 off of my $3,000 investment. That's what I'm talking about. And I've been in situations where I've had over 100 positions. Now, here's the interesting thing. How much available margin do I have with 100 trades open? What was my available margin? It was actually 98% for those that were there at the time. The reason it was only 98% is because 2 of those trades I took that day. Okay? But the other trades all had stops at break even or higher, meaning profit locked in. I couldn't lose money. So imagine now 100 positions open. Now it takes me 9 months to build a portfolio that large. But imagine the carry if you do it right. Okay. And then imagine, guys, it was 8 years ago and I'm not earning 2% or 2.5%. I'm earning 8.5% on my leveraged money. Holy smokes, right? Because now we're talking 850% a year in interest payments. Okay. So anyways, I think that's it. The market hasn't freaked out. You know what? This makes me happy, right? This makes me happy because the market wasn't supposed to freak out, right? We got what we wanted. We got what was supposed to happen. There wasn't any weird mistakes. Where were we? Oh, we're okay. And so now we can allow the institutional investors to slowly build their positions again. And what we want to do is work with them. We don't want to work against them. We're not trying to outsmart the market. Okay. Your account size is not big enough. I don't care if you got, $10 million in your trading account. You're still not big enough to move the market. Okay. So how do you do it? Just like I showed you guys in real time. You see? I did that for you in real time. Could be the beginning of a nice little trade. How does that make you feel? Identify the psych level, identify the 618, set up a reversal pattern before it's actually happened. And now, do we have the giant spread on the trades? No. Are we worried about slippage because the market is so slow and bogged down with huge amounts of order and giant volumes? No. Are we able to sell at resistance with a reversal pattern? Yes. So what we've done is removed a lot of the market risk, and now we're entering logical, intelligent trades based on reversal patterns at resistance if you're a bear. Isn't that how you're supposed to do it? Well, I hope to see you guys tomorrow. Who's definitely going to be in the webinar tomorrow? And I'll teach you day after day after day after day after day after day. I'm here for you. Did you know I didn't take one day off this year? Not one day off. When I travel, I trade, I bring everything with me, and we work together. When I'm on vacation, I take my charts with me and I trade, and I log in, and I share my thoughts with you every day. I've never once took a day off. Even if I'm sick, I'm here for you. I'll never let you down. It's because I love trading so much. It's a game changer for a lot of people. So you're welcome to join my team. It's free. I have nothing to sell you. No DVDs. No premium trading room. Nothing. I'm just here to help you succeed, guys. But it's going to take time. I can't just do 1 or 2 webinars and you're good. Join me every single day, and I'll do whatever I possibly can to keep you, interested, informed, educated. Okay? Yeah, Usman's like, join the webinar now for only $99 a month. No, it's free. How about that? Now, if you want to send me some Cuban cigars, just out of fun, yeah. Or a Mercedes pickup truck, yeah. Forex.Today. That's where you go, Forex.Today. Every single day at Forex.Today. Big, hairy, my humidor is 3 feet tall. Yeah. Actually, someone wants, you want to know how you send me a cigar? I actually found out. Somebody wanted to know. I found it. Where was it? Virtual. Yeah, here it is. You can send me a virtual cigar, man. Do I run a Signals PAM account? If you have $10 million or more, we can talk, but probably not. So don't worry about it. No, a gift card. I don't know. For some reason, it's not working, so I can't even show you the gift card. Come to the daily, yeah, come to the daily webinars, guys. Yeah, Cliff. Yeah, it was good. Good. I don't know where you've been, Cliff, but it was good to see you show up. Yeah, here it is. All right. Yeah, so you can send me a gift card. I think you just put in my email address, wayne@fxbootcamp.com, and then I can spend it here. Buy myself some fancy cigars. So I don't take your I don't take your money, but I'll take your charity. Funny. No, there's a couple of people that keep wanting to send me stuff, and I never could find a way to do it. Yeah, euro's dropping, but it's supposed to, right? We sold it, right? I mean, so I think we're done here. I'm just chit-chatting. I got like, 1,000 things going on here. So why don't we pull the plug? I'll leave this room open a little bit just for you guys to chit-chat amongst yourselves, and if you have some follow-on questions, but I'll stop all the recordings and stuff like that. And I really do hope that you hang with me tomorrow and the next day and the next day and the next day, and we'll spend 2016 together making some pips. One of the reasons I do this is well, because I know you're here, I can't quit. I can't wimp out if I'm sick, if I'm tired, or the market doesn't seem to be moving. I could just say, oh, well, I'm not going to trade today. Well, that's nonsense. So you keep me focused, you keep me sharp. I have to be on my A game every day because I can't let you down. And therefore, it's good for me as a trader. So if I have to share everything I've learned over, 12 years of trading, or actually even more, I'm happy to do that. If that means you become successful, maybe you can work for me one day. Maybe I give you some money and you start trading, right? Yes, Wayne at fxbootcamp.com. Yeah, swap or interest rate payment. Yeah, Guy. Okay. How many people here are successful traders? I'd like to know. If you can make me, I don't know, month after month after month, 3, 4, 500 pips is an okay month. Good months are 8, 9, 10. Eight or nine, 1,000 pips, on a really good month. If you can produce that, yeah, right. Then maybe one day you could be working for me, right? I don't want to trade your PAM account. Why don't you work for me, right? So is 500. Well, it's sort of like everyone has good months, everyone has bad months, right? But you should be able to eke out 300 fairly easy. But inevitably, when I work with someone on a small team environment or on 101, almost always I get people to their first 1,000 pips per month, and they're just blown away. They're just shocked. They're like, I had no idea. Yeah, Tyler got more of that in the first 2 weeks, and he's like, it only took him 2 weeks because he fought me for the first month. He won, or first week. He wanted to trade the way he normally trades. He could have got there earlier, right? Pips, Vladislav, pips. Okay, and then it grows and grows and grows. When you have a large positions, guys, not large positions, but like when I was telling you earlier about portfolio management, if you had 100 trades open, and let's say the dollar moves, whatever, euro dollar over the course of a month moves 400 pips, you make a lot of money. But what you have to also understand, in pips, I've had 15,000 and 20,000 pip months. You just can't do it 1 and 2 trades at a time. What happens is you never end up making any money when you're only doing 1 or 2 trades at a time. So what happens is you get tempted to increase your leverage and increase your lot size so that you start making decent money. The problem is what you're actually doing is increasing your risk. Okay. So what I'm doing is building teams. So if I had 10 guys that no matter what happens, I can count on 500 pips a month or 300 pips a month. 300 pips a month from each one of them, bare minimum. If it's a bad month, at least they're going to chip in their 300. Some guys will do better, right? But then as a portfolio manager and as a team manager, the fund or the firm is going to produce 3,000 pips. That's pretty good, right? It's a start. Plus I'm getting a diversification, right? I don't do that, Adolfo. How do I do? I don't mentor people one-on-one that often. So it's not, it comes down to whether I have the time. I do charge money, and that's a lot of money. It's fair. It's not a lot, but it's fair. But it's not like a business model. Really, I look for people that might potentially, if they become, successful traders that trade in a methodology that I understand and appreciate, then maybe there's, a future in our relationship. And that's what's important to me. But you have to compensate me for my time too, right? No, my hourly fee is $250, and that's only because if I want to do it, I want to do it. So it's $5,000, but I mean, I don't like even talking about it because it's not, I'm not offering that. It's not something. Yeah, it's something. It's the fair market value, but I could do something else with my time for sure. But so right, like Tyler is a very, very, very hard worker. He's very, very focused. He's very coachable. We spend, an hour or two together, and then he'll work on it for 6 hours, 6 or 7 or 8 hours. And the next day we'll meet, and he's like, I did these 19 things based on what you taught me yesterday, and I have all these different things organized for us to review. Why do you think he's so successful so quickly? Because we spend 2 hours together, and he does 12 hours worth of follow-up work and shows up prepared, ready for more information. He's someone in the room here, right? So last time I checked, he was up 60% for the month. No, there he is. Boom, up 60%. Yeah, all right. So it's an all right month. But some of it is my advice and my experience, and some of it is his hard work. Yeah. So I don't know. But obviously not everyone's going to be successful like that. Not everyone has the focus or the experience or the tenacity, but whatever. Well, I appreciate that, Tyler. So I don't know. I'm still here, guys. I don't know why. So peace on earth. May the pips be with you. May your profits be above average. I've been sitting in my chair for like nine or 10 hours, so I think I should probably stand up and walk around. Up. Thank you, Horace. Horace, I'd like to, in fact, do a follow-up. Right? I'd like to do a follow-up. So contact me about that. No, we did a one-on-one, Rich.